we have the Shanghai markets, which are actually gaining close to 3% odd. It's off the high point of the day, but nonetheless, it's up around 2.72% at this point. And one of the reasons why we're seeing possibly the Shanghai markets stabilize in today's trading session is because of the yuan, which is possibly stemmed its deceleration that we've seen for today at least, and that's what most of the reports are talking about. In fact, let's take that conversation forward. We have Maya Bhandari, Director Global Macro Strategy and Asset Allocation, Citi Research, joining in to talk about that. Hi Maya, thanks very much for joining in. In your opinion, what's triggering the yuan devaluation that we've seen?
Well, I think the first point to note with the yuan is nothing happens without the People's Bank of China's consent. The Chinese yuan is a very heavily managed currency, and the PBOC retains control via a daily fix. Now, what it's been doing really since the start of this year is gently raising this daily fix. And then what it did a few days ago was it widened the trading band. So it now allows the yuan to move plus or minus 2% around the fix. So the question is why is the People's Bank of China, wanting the currency weaker? And I think that there are a couple of theories here. One reason could be that the People's Bank of China is trying to squeeze out some of the speculative positioning in the yuan, and that's for both the onshore corporates and for offshore foreign investors. And this line of argument would say, well, they want to squeeze out the speculators, and after that, they're quite happy to return to trend appreciation of the currency to achieve their medium-term rebalancing efforts. Another theory, which honestly resonates better with me, is that China has suffered a huge loss of competitiveness in recent years, partly because the Chinese currency has been strong, and partly because labor costs have increased quite substantially. The current account balance is shrinking quite quickly. The trade balance is now in a deficit. And that really is behind what the PBOC is doing. Now, I'd add to that with speculative positioning still pretty long, dollar CNY, I think that the move in the currency has further to run.
Okay, fair enough, Maya. In that case, should India worry about its exports?
Well, I mean, I suppose my first point would be is India's not a huge exporting country in the wider EM or indeed EM Asian bloc. It's the likes of Korea and Taiwan that are far more sensitive to what's happening in both the Chinese economy and the Chinese exchange rate. So, take Taiwan as an example. It's a very export-driven economy. Almost 30% of its exports head to China. Likewise with Korea, very export-driven economy, 25% of its exports head to China. So, I mean, India wouldn't be at the top of my list of countries that would suffer from a significant yuan devaluation. What I would say, though, is if we look at the trend over the last few years, the trend has very much been a much stronger Chinese yuan vis-a-vis all of these Asian currencies. So we'd really need to, recover some of that before we start talking about material losses of Indian competitiveness.
How worried are you about Chinese shadow banking and the banking system, and can it destabilize the economy?
Well, we remain concerned that China will be unable to deflate its credit boom in an orderly fashion. At over 180% of GDP, Chinese private debt to GDP is high. It may not be as high as some other countries at their peaks, like Japan and Korea. But what's really key is the speed at which it's increased, over 65 percentage points of GDP in the last 5 years. And much of the literature on the subject suggests that it's the speed of increase that often precipitates crises. And I think we can also learn from Japan that high levels of reserves and good savings ratios are often not enough to deter a crunch coming when it comes. Now, the problem with all of this, so the difficulty is in the precise timing. It could be a 2014 event. You mentioned a couple of defaults. Now we have something in the region of 3 to 5 trillion of trust loans falling due in 2014. So 2014 is a possibility. Equally, it could be a 2015 event. The consequences, I think, if it did occur, would be quite significantly destabilizing.
Okay. What's your view of the trajectory of the Chinese economic growth, and are you worried about a slowdown and a decline in the GDP growth?
Well, I mean, I don't make the forecast for growth here. Our economists think growth is likely to come in at 7.3% in China this year, 7% next year, and those growth rates, of course, don't pose a material challenge to either EM or to commodities. I suppose what I've just highlighted are some of the downside risks to those growth forecasts in the event of a credit event. And I think in that instance we would see, a downward surprise, if you like, to Chinese GDP, and that, of course, would have fairly significant impacts on EMs, not just in Asia, but also, of course, in Latin America, with the likes of Brazil and Chile very much connected to China through the commodities route.
Okay, Maya, now coming to larger issues, do you see continued outflows from EM funds in 2014?
Well, let's take a little step back and think about what's driven these outflows so far. What's driven these outflows so far, in our view, is a combination of worse EM macro backdrops and tighter global liquidity conditions. Now, according to Citi's forecast, neither of these drivers gets better. In fact, both get worse. So, our GDP forecasts continue to be revised lower. Inflation stays high and sticky, and current account balances continue to deteriorate. I mean, emerging markets, including China, are forecast to fall into a current account deficit this year for the first time since the late 1990s. So the EM macro scenario isn't improving. Meanwhile, global liquidity conditions are already tightening, and certainly from the Fed, on the basis of what we heard from the FOMC last night, tightening may come sooner. And I think in that context, we still have a fairly substantial international overweight in both EM equities and also EM bonds. I mean, we've seen very large inflows into both these asset classes, and these have only just started to reverse. So to answer your question, in the context of what I just described, there is still a significant room for some of these, for outflows to continue in emerging markets this year.
Thank you, Maya, for taking the time out and joining us. On that note, it's time for a